Welcome back to the Deep Dive. Today, we are taking on what is really the scaffolding of modern finance, portfolio construction.
Yeah.
This is where it all comes together. It's the ultimate synthesis, where professional advisors blend risk, asset classes, the whole economic outlook, and human behavior, all into one cohesive plan.
It really is the highest level of financial engineering, you know?
Yeah.
And our mission today is to cut through all the noise you hear, all the market commentary, and really understand the core principles, the repeatable stuff.
The things that actually work.
Exactly. How do the experts build these portfolios for the long term? How do they balance stability, growth, and risk all at the same time?
Okay, let's unpack that. We've pulled together a stack of materials. And what's interesting is if you strip away all the complexity, the entire process really starts with one single idea.
Balance.
Balance.
Precisely. The moment you decide to invest, you run straight into this fundamental dilemma, which is that every single asset class has a trade-off. There's no perfect investment out there that gives you high growth, zero volatility, and instant liquidity. It just doesn't exist.
So the advisor's job isn't to pick a winner. It's more like mixing a stable team.
Yeah.
So who are the key players on that team?
Well, you have your primary growth engine,
Right.
equities, stocks.
Right.
They offer the highest potential returns over the long term, but they bring the volatility, they bring the risk of losing capital. Then you have bonds.
The ballast.
The ballast, that's a perfect word. They're there to provide stability, some income, and limit the downside, but, you know, their long-term growth is inherently limited.
And often when the market crashes, equities go down, but those high-quality bonds, they can actually move in the opposite direction.
That's the whole point.
That's where the balance starts to pay off.
It is. Then you have cash. It gives you instant liquidity. You can get to it today. But its main risk is inflation. It just slowly erodes your purchasing power over time.
Okay, and the last piece.
Finally, you might look at things like property and various alternatives. These are mainly for diversification, but they come with their own complexity and, you know, specific risks. The big one being illiquidity. You can't just sell them tomorrow.
So we have these diverse ingredients.
Sure.
And that brings us, I think, directly to the bedrock of any successful long-term strategy, which is strategic asset allocation.
Strategic asset allocation, or SAA. This is the foundation. It's the long-term structural mix of assets, say 60% equities, 40% bonds, that is explicitly designed to match your risk profile and your financial goals. And critically, this mix, it stays relatively stable over long periods.
That sounds like the hardest part because you have to sort of stare into the future and decide who the investor is financially for, what, the next 20 years?
That's right. And think about the stark contrast in these SAA profiles. A cautious investor, someone who's prioritizing capital preservation, they might have a huge allocation to bonds, cash, maybe some utility stocks.
Very different from a growth investor.
Completely. A growth investor, maybe they're younger or have substantial wealth already, they're going to be heavily weighted toward equities. They accept those bigger drawdowns because they're chasing higher long-term compounding.
Okay, and this is where we hit the absolute key insight for you, the listener. This is the one that might just overturn everything you thought you knew about investing. It's about where performance actually comes from. We spend so much time hearing about stock tips and market timing, but what really drives the portfolio?
The research on this is just overwhelming. Yeah. While individual stock picking and trying to time the market get all the media attention, studies have shown that the strategic asset allocation is responsible for the overwhelming majority of a portfolio's long-term behavior and its ultimate performance.
When you say overwhelming majority, give us a number. What are we talking about?
Well, the seminal study estimated it was responsible for over 90% of the long-term return variance. The actual magic, the true heavy lifting, it happens when you set the right proportions of stocks, bonds, and cash, not in picking the next hot stock.
That is the ultimate aha moment.
It is. If you get the structure right for your risk tolerance, you've basically won most of the battle already.
It's not about being fast. It's about being fundamentally structured.
Yeah.
Okay, so once that long-term SAA foundation is firmly set, what kind of fine-tuning or, minor adjustments are advisors allowed to make?
That's when we might cautiously discuss tactical asset allocation, or TAA. This is the attempt to add marginal value. It involves small, temporary shifts from the SAA mix, maybe nudging the equity allocation by 2 or 3%, based on a short-term market view.
Hang on, that sounds like an invitation to start market timing again. We just agree that doesn't drive 90% of the returns. If SAA does all the heavy lifting, why even bother with TAA? Isn't it just expensive window dressing?
That's a very fair question, a critical one. And it's used because, look, market dislocations do happen. Sometimes an area is just demonstrably undervalued because of sentiment. But, and you have to highlight this, it requires immense discipline.
And it carries risks.
Huge risks. Transaction costs, tax implications, and the very real risk of just being wrong. In fact, many high-quality advisors choose not to use TAA at all, precisely because trying to consistently beat your own SAA benchmark through these little shifts is just, it's statistically really rare.
So TAA is used. It's got to be small, temporary, and it can never endanger the core plan. But all of these decisions, strategic or tactical, they run straight into one major constraint: suitability.
This is the non-negotiable core of professional advice. Suitability means any investment recommendation, any allocation has to be in the client's best interest. It's not just an ethical standard, it's a regulatory requirement.
So if an advisor makes a shift, say a tactical bet, that pushes a cautious client into a really aggressive position, what does a suitability failure actually look like?
It's a complete breakdown of trust and ethical responsibility. It means the client has been exposed to a level of risk they neither understood nor consented to. It could lead to regulatory censure for the advisor, and, more importantly, it could expose the client to catastrophic losses. It's the ultimate stop-loss against emotional or overly aggressive decisions by a professional.
Stability, suitability, and SAA driving returns.
Got it. Now let's drill down into the mechanics of risk. How do we make sure that when the market does inevitably pull back, the portfolio doesn't get completely dominated by one single negative factor? And this, I guess, is the definition of diversification.
Diversification is the central tool for managing risk. But the goal isn't just to hold lots of different things. The goal is to hold assets that have a low correlation to one another.
Low correlation. That's the deeper insight. It's not just holding stocks and bonds, it's holding things that don't all crash at the same time. Exactly. When asset A is going down, ideally, asset B is staying flat or maybe even going up. And that counteraction gives you a smoother, more predictable journey. You're trying to minimize the drawdown. That's the maximum loss from the peak to the bottom.
So how do advisors layer that diversification? Give us some specific methods.
We start with asset classes, like we discussed. But then we drill down. Within equities, we diversify regionally, U.S., Europe, Asia, emerging markets, to spread out political and economic risk.
Right.
We diversify by sector tech, healthcare, energy, so you're not tied to one industry cycle. And then we can also use what's called factor diversification. This is a bit more sophisticated.
Factor.
Yeah, so instead of just picking stocks, advisors might target specific systematic factors of return. Things like value stocks, which are undervalued, or momentum stocks, which are trending upwards. The idea is these different styles often perform well at different points in the economic cycle, so they balance each other out.
That makes sense. That layering makes the portfolio resilient because you're protected not just against one bad region, but also one bad style of investing. That's real risk management.
It is. But none of this structure can be determined without the critical anchor, the investor's time horizon. Time is what fundamentally dictates your capacity to take risk.
Okay, so how does the length of the journey really change the asset blend? Let's go back to those 3 common client scenarios.
Let's start with the young client, decades from retirement. Their time horizon means they have years of compounding ahead and, crucially, a massive opportunity to recover from any market downturns. Their capacity for risk is high.
So lots of equities.
A very high proportion, possibly 80% or more, because time is literally their biggest defense against volatility.
Right.
Now contrast that with a client who is 5 years away from retirement. They need to protect the capital they plan to spend soon. For them, risk capacity is low. We move heavily into short-duration bonds and cash. The goal shifts from maximum growth to capital preservation.
You just can't risk a big correction right before you need the money.
You can't. And then there's the most complex scenario. The client who is already in retirement and drawing an income. How do you build their portfolio for sustainability?
I imagine that's tricky.
It is. This is where we often segment the portfolio. The portion you need for immediate living expenses, say the next 5 years of withdrawals, that's held in highly stable income-producing assets, like high-grade bonds.
Okay, that covers the short term.
And then the remaining longer-term capital is kept invested for growth, to fight inflation over a potentially 30-year retirement. The advisor has to build this blend to support withdrawals without depleting the capital too quickly. It's a dynamic balance between protecting today and planning for a long future.
That detailed approach really shows how much the risk and return target changes based on when you actually need the money.
Okay.
Okay, we've set the structure, managed risk through low correlation, accounted for time. But portfolios like gardens, they need maintenance. Let's talk about rebalancing.
Rebalancing is essential maintenance because that SAA mix, it rarely stays put. If equities have a phenomenal year, they might balloon from their target 50% weight up to, say, 65% of the total portfolio.
So the portfolio has unintentionally become more aggressive than the client ever agreed to.
Correct. And the core function of rebalancing is to prevent that drift. You sell a portion of the assets that have done really well, the equities in this case, and use the money to buy the assets that have lagged, like the bonds. And this brings the mix back to the original 50-50 target.
That is an inherently disciplined, almost anti-emotional action, isn't it? You're forcing yourself to sell high and buy low, which goes against every instinct during a bull market.
It absolutely is. Rebalancing is the active exercise of discipline. It removes emotional inputs like chasing winners, and it mechanically ensures the portfolio's risk profile stays consistent with what the client signed up for.
And how often does this happen?
Typically, it's done periodically, maybe annually, or whenever the allocation drifts by more than a set amount.
Speaking of emotions, portfolio construction isn't just a spreadsheet problem. It's a behavioral science problem. How does the professional manage the client's consistency, especially during a painful market downturn?
A well-constructed portfolio really serves as an emotional circuit breaker.
Yeah.
By diversifying and balancing the assets, the severity of the volatility is reduced. That makes downturns less jarring and helps manage the client's instinct to panic.
Because the biggest single mistake an investor can make is selling at the bottom.
Without question. The advisor's role here is to provide perspective, to be the anchor. They help the client focus on the multi-decade SAA strategy rather than the short-term noise. They prevent that emotionally driven panic sale that guarantees a permanent loss of capital.
Right. Finally, let's talk about the practical reality of money. Costs and liquidity. Let's start with costs.
Costs are crucial because they directly subtract from your long-term returns. Even a seemingly small difference in a fund's expense ratio, say 0.5% versus 1%, can compound into tens of thousands of dollars over decades.
So advisors have to be focused on that.
They must. They have to select cost-efficient products and make sure the client understands the total expense ratio of their investments. And this is where the whole debate over active versus passive management comes in.
Right.
Passive funds, like broad index trackers, offer really cost-efficient exposure. They often form the core of a strategic allocation. Active funds, the ones with higher fees, are only justifiable if the advisor genuinely believes that manager can consistently provide an advantage that far outweighs the extra cost.
And last, liquidity. It defines the usable part of your portfolio. What's the trade-off here?
Liquidity is essential. An advisor must make sure a client can access cash quickly for emergencies. The trade-off is often called the illiquidity premium.
The illiquidity premium, what's that?
Well, assets that are difficult to sell quickly, like private equity or a physical property, they often offer the potential for higher expected returns precisely because they lock up your capital. So advisors have to use these illiquid assets very carefully. You only put a proportion in there that the client can afford to have locked away for years.
You don't want someone relying on selling an office building to pay for an emergency surgery.
Exactly. This has been a true deep dive into the discipline behind the process. To summarize, portfolio construction is this art and science of blending investments into a highly customized, suitable, and disciplined plan. It relies on the heavy lifting of the strategic asset allocation.
Thoughtful diversification to get that low correlation, constant maintenance through rebalancing, and crucial behavioral coaching, all while strictly managing costs and liquidity.
That covers the structure perfectly. And if we connect this all back to you, the listener, it's vital to understand that this structure requires continuous monitoring. The market changes, sure, but far more important are the fundamental shifts in your personal life.
Right. New jobs, shifting income, major family expenses, inheritances, all of these things can dramatically change your risk capacity and your time horizon.
Which raises an important question you should carry forward from this deep dive. Suitability is not a fixed measurement taken on day one. It is a continuous, living responsibility. If your portfolio was built to support you as a working professional with 20 years to retirement, how must that construction change the day you actually retire, or the day you have an unexpected family shift?
So the final thought is,
What aspects of your own life have changed recently that might mean your portfolio needs a complete review to make sure the structure still serves the person you are today?